Today, we're going to pull back the curtain on technical analysis. We're not just going to stare at charts, we're going to learn how to actually read the story that's hidden inside them. And we'll do it by looking at one single, incredibly volatile stock. So let's just dive right in. How do you read a stock story? I mean, you look at a chart. Is it just a bunch of random squiggly lines? Or is there a real story in there? A narrative of fear, of greed, and of conviction just waiting for you to piece it together? Well, that's what technical analysis is all about. And the story we're investigating today? It's the absolutely chaotic tale of a company called DarioHealth, ticker symbol DRIO. Its chart over the last few months is, well, it's a perfect mystery for us to solve. A real roller coaster. Okay, so our story kicks off back in late June. DarioHealth is trading at a pretty respectable $13.52 a share. But then, the plot takes a seriously dramatic turn. By the middle of September, the stock absolutely collapses. It plunges all the way down to a low of just $5.93. That is a massive, painful drop. And just when you think the story's over, boom, a stunning rebound sends it rocketing all the way back to $12.40 in just 10 days. So what on earth is going on here? That is the exact question we're here to answer. All right, this brings us to the first part of our investigation, a stock's wild ride. Because this isn't just random volatility. This is a story packed with seriously conflicting signals that any analyst would need to untangle. So here's the puzzle, right? We have two completely opposite stories happening at the exact same time. On one hand, the long-term picture looks pretty bad. It's bearish. The stock is still trading 50% below where it was when our story started. But on the other hand, the short-term story is incredibly bullish. It's all about that violent, super powerful rally off those September lows. How does anyone make sense of that contradiction? Well, to solve this mystery, we start by looking for the most basic evidence out there, the clues hidden in price and in volume. You can think of it like a detective following the money and the momentum to see where the big players are making their moves. Let's just walk through the key moments in DIO's recent history. From June to July, things are kind of calm. You see a gradual, pretty orderly decline. But then, on September 10th, the bottom just falls out, a total collapse. September 16th marks the low point, what analysts call a capitulation low, where it seems like everyone is just throwing in the towel and selling. And that moment, right there, sets the stage for the explosive rally that peaked on September 25th. Now, here's where the story gets really juicy. Let's talk about trading volume. On a totally normal day, less than 50,000 shares of DRIO get traded. But look at these key moments. At that capitulation low, volume exploded to over 71 million shares. And at the peak of the rally, a mind-blowing 162 million shares. That's not just background noise. That's the market screaming. And that right there shows you a core idea in analysis. Huge volume confirms conviction. It means these big price moves are not accidents. They're being backed by a massive amount of buying or selling pressure. It tells us that these moments in the stock story are a big deal, and we absolutely cannot ignore them. But, price and volume are just the surface clues. To dig deeper into this mystery, we need to look inside the analyst's toolkit. These are specialized indicators that help us find clues that aren't immediately obvious just by looking at the chart. First up, we've got a classic, the moving average. The best way to think about it is as a tool that just smooths out all the chaotic day-to-day price spikes so you can see the real underlying trend. It helps you stop focusing on every single tree and finally see which way the whole forest is moving. And for Drio, the moving averages perfectly capture our conflicting story. The short-term averages? They're all flashing green. They're signaling strength, confirming the power of that recent rebound. But that big, important, long-term 200-day average is sitting up there around $13.05, acting like a giant wall of resistance, reminding us of that stubborn, bearish long-term trend. Another really popular tool is the MACD. Now, it stands for Moving Average Convergence Divergence, but don't worry about that. All you need to know is it's a momentum indicator. Its job is to tell an analyst if the recent trend is gaining steam or if it's kind of running out of puff. So when we put all of our main tools together, our toolkit is giving us a total table of mixed signals. The MACD and a key volume indicator, they're bullish. They're cheering on this recent rally. Another momentum tool, the RSI, is just neutral. It's not picking a side. but that big, powerful long-term moving average is still firmly bearish. The plot just keeps getting thicker. Okay, so with all these clues gathered, it's time for the next phase of our investigation, mapping future scenarios. This is where an analyst uses all that evidence to define the key battleground levels that are probably going to decide where the story goes next. And to do that, we use two of the most critical concepts in all of technical analysis: support and resistance. The easiest way to think about it is like this. Support is a price floor, a level where buyers have historically stepped in to prop the stock up. Resistance is the opposite. It's a price ceiling, where sellers tend to show up and push the price back down. For DRIO, the key battle lines are drawn. The crucial support floor is right there at $11.85. For the bullish story to have any chance of continuing, the stock has to hold this level, period. Meanwhile, the immediate ceiling it needs to punch through is at $12.93. If it breaks through that, it would be a major, major victory for the bulls. So, these two key levels, the floor and the ceiling, give us three pretty distinct potential paths for DRU. First, the bullish case. The stock smashes above that resistance at $12.93 and just keeps charging higher. Second, the neutral case. It gets stuck, trading sideways between the floor and the ceiling while the market just tries to figure out what to do next. And third, the bearish case. It fails to hold that support at $11.85, and this whole exciting rally just fizzles out. Which brings us to our conclusion. After looking at all the evidence, it's time for the analyst final verdict, piecing all of these clues together into one coherent summary. You know, this whole investigation really boils down to this one quote from the analysis. Drio exhibits a complex duality. Short-term bullish momentum contrasts with the persistent long-term downtrend. In simple terms, this stock is at war with itself. It's a battle between the really optimistic story of the last few weeks and the pretty pessimistic story of the last few months. And that leaves us with the final crucial question. Is this a powerful short-term rally that's signaling a true, lasting turnaround for the stock? Or is it a long-term trap, just luring optimistic investors in right before the next leg down? See, technical analysis doesn't give you a crystal ball to predict the future. What it does give you is the map, the key levels, and the right questions to ask so you can understand the story as it unfolds.